Good morning, everyone, and welcome to our Amati Strategic Metals Boots on the Ground Gaining an Advantage webinar. Thank you for joining us. My name's John Woolley. I'm part of the sales and marketing team here at Amati and joined by both managers today, George and Mark, which is great. Now, today's session is not your usual fund update session. We thought we'd do something very different. Of course, those are important. We'll continue to do those. But we want to do something a little different that we thought would be of interest to investors, and also kind of provide a bit of insight into, George and Mark, a mining engineer and a geologist. What is it they actually kind of cover on a site visit, and what is it they actually do when they head off to the various parts of the world, and is it as exciting as it all sounds? But just before we get going, just a very, very high level recap on the fund first. This is a global mining fund, so we can invest in the manner of any commodity. The current sort of bias in the fund is towards precious metals, but that can change and will evolve over time. So it's an active strategy, but also the focus is on that small and mid cap area of the market. And of course, if you're going to get involved in those areas of the market, you need the right skill set and the right technical knowledge to be able to do that. The site visits is all very much part of that picture and help building a picture about the companies that the team invest in. So today's webinar is really about, one, why do the team invest in small and mid caps? What is it that they're looking to capture when they're investing in these companies, and how site visits very much fit into that, and where it gives us our edge. So hopefully something a bit different. I think it's going to be really interesting. We'll take questions, please, at the end of the session as usual. The question bar's on the right-hand side. Please post your questions. And at that point, I think I'll hand over to George.
Thanks, John. I will start off by speaking briefly about the trip that I conducted to Brazil to look at the development of the construction of G Mining's first mine. And then Mark will take over and he'll discuss his trip to Guyana and really share with you why it really quickly became apparent that the discoveries made in Guyana would turn out to be arguably the best discoveries made in the past 3 decades. The tie-in with G Mining Ventures is that G Mining equally recognized this. Actually, the mine evaluations team was instrumental in doing the initial study on these deposits for Reunion Mining, and they acquired Reunion Mining in a bidding war. In the past few years, G Mining Ventures has grown from a company of around $100 million to over $3 billion today. So you can clearly see where real value is created in this industry, and that's through successfully developing projects and through the drill bit, which is really a term that we use for exploration success. Just going back to the disclaimer here, and this is just that this presentation is really just a glimpse on the process that we employ to run the fund, and it doesn't guarantee success for everybody who's on the call or listening to the webcast in the future. These are just a few pictures of what we see and what we do on the ground in mine site. Not always the most comfortable places to visit, and Mark will elaborate on that a bit later in the presentation. And that's maybe why so few fund managers don't conduct these trips. It takes a long time. It's difficult to get to. But what we want to share with you today is the invaluable information that we get from doing these trips. For those of you who are familiar with the Amati Strategic Metals Fund, we do have a different approach to most metal funds out there, in that we don't just hug the index for the sake of it, but we focus on high growth producers with significant upside or production upside potential, developers, as well as very exciting world-class late stage exploration companies. one of the reasons why we're really excited about the market right now is that we believe that we are in the earlier stages of a recovery in the metal sector relative to the rest of the market. And usually during that period, we have money flowing into the very liquid large cap stocks. They sort of your defensive stocks, and that's really what's taken place in the past 12 months, is that we've seen the development of 8 or 10 very large so-called hot stocks, and that's created a disparity of valuations between those stocks and the rest of the market. So this means that money is starting to trickle down into the mid-cap sectors, into the developers, and we're seeing heightened M&A activity. And by using our discipline, our complex in-house financial models, and combining that with site visits to the operations, I believe it sort of gives us an edge, and that's what I think is really going to drive the performance of this fund in the next few years. And really what we try to show today is the edge from using our experience and our global network to dig out and find these nuggets that we call it, or investment opportunities. This is the only slide that I'm really going to spend some time talking about the fund itself. Call it strategic metals, metals that are strategic for the global economy going forward. We invest in the battery metal sector, the base metal sector, the uranium sector, as well as the precious metal sector. John mentioned earlier we have a bias right now to precious metals, and this really came about because it was the most oversold sector. Even though the gold and silver prices were moving up, there was a natural negative bias towards the sector, and we're seeing really good value in the sector compared to the value that we could recognize in the base metal sector at the time, or the uranium sector, even the base battery metals, where we find a lot of very good value right now, but we don't think we're near a turning point as far as investor sentiment is concerned. We run a highly active fund. We keep 98 to 100% invested at all times, and we can't move between these sectors depending on the valuations. John also mentioned we focus on the mid caps and the developers, but it's not that small of a market cap. On average, the market cap in the portfolio is above $2.1 billion. So it's not, we don't invest in companies below $250 million market cap, for example. And we have a great discipline when it comes to looking at companies and deciding whether to invest or not. What comes into our screen when we look at these companies? We like low price to net asset value companies, low price to cash flow companies, and very importantly, we like the companies where we can see a lot of upside that is not baked into the share prices at this stage. And we keep a very focused fund in order to be on top of these companies, and to conduct the site visits, to update it with all the news coming out. We really just keep a portfolio of 36 companies in the portfolio. Now, I wanted to, some of those people who've looked at the mining sector for a while are familiar with the Lassonde curve. It's a curve that was developed by Pierre Lassonde. He was chairman of the World Gold Council. He was the founder of Franco-Nevada, as well as the ex-chairman of Newmont Mining. And this is through his experience. He looked at the life cycle of any mining company from the discovery all the way to production. And you can see two big curves that come through. Initially, you get this discovery, speculation comes in, everybody buys the stock, it ramps up very, very quickly, and then reality hits the road when you start putting economic parameters around this deposit. Does it hang together? Because in reality, only one discovery out of 20 really makes it to production at the end of the day. and then we enter into what we call the orphan phase. This is the phase where you're doing pre-feasibility studies, feasibility studies, and you're doing the capital raising for the projects. And it's typically from that phase, that orphan phase, all the way through to production and beyond. That hashed line that you see there is really a lot of successful companies build the mines, and then they continue to drill outside of the deposit that they've identified at the time of making this final investment decision to build the mine. They cut it off, and then once the mine's operating, they continue to drill outside of the known deposit and add those ounces into the mine plan to create further value. So really, where you make, as an investor, where you make the greatest return is investing at the bottom that you see there of the orphan phase, all the way through to production and beyond. Obviously, it takes a bit more risk, and this is why I think it's imperative that you go out to see site and the sites, and that's what we wanted to share with you today. So rather than investing and praying that we are correct on our commodity price calls, this is how we manage the fund. The first company that I will share with you, which is the trip I made in 2023 to Brazil to see the development of G Mining Ventures, a Tocantinzinho mine that you can see you can see how remote it is, deep in the Amazon jungle. G Mining Ventures was created by the Gignac family of mine builders out of Quebec in Canada, who were very successful in constructing mines in very remote, challenging regions for the likes of Lundin Gold in Ecuador, Newmont in Suriname, as well as IAMGOLD in Suriname and in Guyana. So they had their credentials, they are highly regarded team, and they said, can we find a deposit that's available to us? And this is where Eldorado Gold had the Tocantinzinho project for many years, but they corporately, the balance sheet was under strain because of development of a big project in Greece, and they decided to shift the focus of the company to Greece, Turkey, and Canada. And this was the only asset that they had in Latin America. So that allowed G Mining Ventures to pick up the asset. At the time, there was a pre-feasibility study on Tocantinzinho by Eldorado Gold that was done using a gold price of $1,400 an ounce. G Mining Ventures picked up the asset for 0.28 times net asset value at the time. The gold price, at the spot gold price, was around $2,000 an ounce. But they continued through the permitting and through the construction, and last year this mine went into production. Now, again, when we talk about how challenging it is, I took a plane with the management team and a couple of analysts. There was one other fund manager on the trip. It was a small plane, 2 hours from the city of Manaus in northern Brazil, and it really gave you this trip a very good appreciation for the infrastructure challenge, logistic challenge of actually building a mine in a remote area, trying to get men and materials to site, and also gave you an idea of, are there villages nearby that could be disrupted by the expansion of the mine in the future. We also flew past a number of neighboring properties where the deposits are not large enough to be standalone mine, which gives, spatially, you look at this and say, yes, these deposits could fit into G mining in the future. You can see on this diagram, at the back is where the open pit will be. In the front will be the processing plant and main offices, and the permanent camp on the left-hand side. Also, you may see right in the background a few clearings where these are other anomalies and other deposits that they've identified, which they will continue to drill out, and probably will mine those deposits over the life of mine. What was also apparent was, and I don't have this slide here, was the number of illegal mining operations in that entire region. It was littered with, they call it Garimpero operations, which really gives you a glimpse of the prospectivity of this whole region and the undeveloped nature of the region. A very good insight is to get out on site, and this is where you're looking for fatal flaws. This is where you're looking at what kind of culture is being instilled at the operation from day one, because this will really determine whether this will be a successful mine over the longer run. You're looking at the quality of the roads. You're looking at the drainage systems that they've got. You're looking at the trucking distance, the choice of equipment that they've used. You're going to the living quarters. You're looking at what kind of environment will the workers be housed in, and what kind of food that they're going to receive. We had lunch with the workers as well, and you can read from the body language as well what the feeling is at the camp. In the evening, we met senior managers of the development team, and there again a lot of questions on what could go wrong, what are the critical paths for developing this mine. Have they been, are the targets stretch targets or not? And usually they give you a glimpse. You can see in the body language these guys are confident of delivering on time, on budget. I think a social license to operate is imperative. If you don't have a social license to operate in any country, you don't have a mine, you don't have a company. And what they particularly G mining, they spend a lot of time on the bringing the communities, looking after the environment. They obviously excavating part of the jungle, the Amazon jungle, the care of moving the animals, the care of recovering all the plant species that they come across, and actually nurturing them in a nursery to replant at the end of the life of mine. And they have a whole team dedicated to this. So this really became for us a key investment. And when we look at all our metrics that we look for in an investment, this was at the time we invested in 2022, he had an enterprise value of only $129 million. It was trading at 0.2 times net asset value. Clearly, after the mine site visit, we could see it's exceeding plan, and there was obvious exploration upside potential. We have a detailed financial model incorporating the definitive feasibility studies. We've conducted the mine site visits, and we have a vast network of financial brokers in Canada who cover the stocks, and we use them as well in discussing, are there any fatal flaws that we might have missed. And then obviously we're using the build team's track record. I'd actually been to Ecuador, Lundin Gold's operation, which was developed by the same team. So I was very familiar with the team and what they could achieve. We analyzed the risk as well as the social license to operate. And you can see why this is important. We started buying in 2022. The site visit was in 2023. If I recall, it was around the end of February, beginning of March 2023. And you can see the performance of this stock has done. This is the chart from the latest presentation. You can see 175% that this company has, the performance since that point in time, compared to 11% for the GDXJ index and 96% for the gold price. And where we stand today, The production growth from today over the next 3 years is 177%, up to just over 500,000 ounces per year. There's no other company in the mid cap space that has that kind of growth potential. Put there, it was 0.85 times net asset value. Updating today with the gold price and using spot gold price, it's closer to 0.63 times net asset value, and that doesn't include the exploration upside potential. The all-in cost running at about $1,100 an ounce, and against a gold price of $3,300 an ounce, you can see how immensely profitable this company is and will be into the future. So it's become a coveted core holding for us, but also for all the other major gold funds are starting to buy into the company. The last point I want to share with you on this slide is that you can see the performance in 2024 onwards, and that was really following initially a dip, and then following the acquisition of Reunion Mining, where the market really started to understand what Reunion brings to the company. On that point, I want to hand over to Mark. Over to you, Mark.
Thank you, George. And what I'm going to do is use a site visit to Reunion and G2 Goldfields to demonstrate what we do on site, but also then try and bring that back to the technical investment and valuation thesis of the Lassonde curve, and how developing an asset works in real life to that investment curve that Pierre Lassonde came up with. For me, back in May 2023, I visited the exploration and development assets of Reunion and G2 in Guyana, Latin America. And I use this to show you what the boots on the ground is, and I'm going to highlight what I look for when conducting a site visit. And it's really about getting out from behind the desk. And for us, the site visit is a key part of our investment process, which George has already touched on. You know, it allows us to access the spatial setting of a deposit, and in order to try and contextualize the resource within that spatial setting, what type of potential mining scenario you could use in this setting, and then also any environmental implications and impact of that operational scenario. The trip also can highlight any fatal flaws which we didn't appreciate when we do our desktop reviews. So there are opportunities to seek out negative issues with assets, and obviously you don't invest when you find them. But it also allows us on the positive side to look for opportunities not recognized by the wider market when they just do their Bloomberg screening and their Excel spreadsheet analysis. So needless to say, you know, the Amati boots on the ground approach takes effort and many forms of transport to get to these very remote but very exciting areas. You know, in this case for me, it was a 12-hour flight from the UK to Georgetown, which is the capital city of Guyana, via Barbados, and then collectively 120 kilometers of speedboat up the delta with a jeep track journey southwest of Georgetown to the Oko Gold District deep in the rainforest. This is untouched potential. And what I'm going to do here is the next two slides, I want to try and show you the past and present of that Goldfields that I visited. And you see the picture on the left here from 1A to 3A. That's showing you the logistics and infrastructure and the mining of those alluvial goldfields back in the 1990s. On the right-hand side, the pictures in 1B to 3B show what it was like when I visited in May 2023. And importantly for me, not much has changed in terms of the operations. That creates untouched potential. The next set of slides here really shows you the exploration techniques have radically moved on since the 1900s. But importantly, the rocks have stayed the same. Geology doesn't change. And the potential value creation through exploration and the drill bit really becomes obvious if you spend time on site and you make the effort to visit these remote and relatively untouched areas. You see on back here on 4A, the Amaru geologists back in the 1900s. And that really compares to the advanced exploration techniques you see today. And those methods of exploration have significantly improved. But as I said, the rocks have stayed the same. And the point here is that based on the tectonic and the geochronological data, it's presumed that the Amazonian basin, where I visited and George visited, and the West African cratons were joined and were part of the Gondwanland continent when they were joined up before the Atlantic Ocean opened up over 250 million years ago. So what? Well, what does that mean? Well, the West African craton is known for its multiple gold deposits, and it's got an endowment of well over 300 million ounces of resource. The Guyana Shield contains very similar geology, but a large part of the shield is still underexplored. That's our opportunity due to the sparse population, the limited rock outcrops, and the dense tropical forest. And it's no surprise that the gold endowment on the Guyana Shield is only 30% of that of the West African craton, and it's the same geology. So there's untouched potential, and there's the exploration and development waiting to happen. These gold discoveries are numerous in this area. There's a lot of alluvial mining, as George pointed out, and there's a lot of exploration activities on a small scale. So that's giving us evidence that there's geological and gold potential in this Guyana Shield. And importantly, the greenstone belt here in Guyana is very similar to the greenstone belt in the Abitibi in Canada and the Birimian gold belt in West Africa. And both these regions host multi-million ounce gold mines. So the important thing here, the geology never stops at the border, be it a property border or sovereign border. This is all about spatial awareness. George kind of touched on it a little bit. And what this site visit provided for me was a spatial awareness of a 20-kilometer long structural shear zone, structural corridor. Put simply, then I put myself in the situation and asked myself, well, can I visualize a mine here on its simplest form, be it an open pit mine or an underground mine? And clearly in this setting, the answer is yes. So the first box has been ticked, and then we start to try and appreciate the scale of the setting. And it's about that scale. There's every evidence that these two companies here, and this is in the middle photograph, the two companies share the same district scale ore body. You've got Reunion in the top, and you've got G2 Goldfields in the bottom there. And clearly in this view looking south, you can see the exploration camps of Reunion and G2 are connected by the Guyanese legal scale mining. As a geologist and an investor, this is important because I look for these geological belts or geological camps, as they're called, and hope that they're still in the hands of junior mining or exploration companies. Now I'll go through really the Reunion site visit, and there are many superlatives bandied around about these style of gold camps, the untouched potential in this scenario. But it's clear to me that the scale of this deposit is world class, and in our minds, this Oko gold belt will eventually be in the hands of a major. So in this scenario, we benefit from 1, value through the drill bit, 2, investing in a development risk where the market doesn't pay full value for the asset, but we buy in at a discount, and that value is unlocked as they develop the asset. And the third, which is that third leg of our stool that we continually talk about, is M&A. Now, on the site visit to Reunion, I arrived at the exploration camp and I visited the core shack. You can see there the sample preparation facilities. You visit the drill rig. We went to the outcrops, broadly showing the evidence of that regional shearing connecting the two companies. And this is all part of our QA/QC. QA/QC, quality assurance, quality control. So when I go on site, I check that the sample prep facilities are in good order. And also, importantly, that the data and their practices are audited by an independent person or company. I also check that the drill core is collected and analyzed correctly. And then importantly, that the data and the assay results, the gold or the mineralization results, are stored in a suitable database, which is managed, audited, and accessible. To some degree, doing this QA/QC prevents us from investing in another Bre-X style company. And for those who don't know what Bre-X is, It's a Canadian gold mining company scam based in Indonesia. And if you don't know that, you can see Matthew McConaughey on the Netflix film Gold, and that may broaden your understanding of what scams are out there. Again, the reunion site visit, we have an orientation presentation, and this is a standard methodology that you go through on site. And that's really to better understand the broader structural geology. We analyze the drill core, and we look at the geological cross sections and long sections. And what this does, it provides me evidence and initial understanding of what are the controls on mineralization. And then with that understanding, I can then go out and look for other geological opportunities during that site visit with the knowledge I've gleaned from the classroom. Put simply, this allows me to validate the existing work that the geologists and the company have done, and also access and assess really the potential future discovery in the region. And in this case, it's important to stress that the key here was to unlocking value was through the discovery of distinct plunging high-grade ore shoots. And you see that on the right-hand side of the chart there, the pink cross-section, long section, the high-grade starts to plunge. And that's really important in this scenario, and also understanding the regional structures and the opportunity at G2. So bear that in mind, the plunge. When I visited Reunion, they had delineated around 2 million ounces of gold at the Karuni zone, and that was mainly in Block 4. And that was through soil sampling, it was through trenching, geophysical surveys, and then that was followed up by over 44,000 meters of drilling. They defined a mineralized zone back in 2023 of around 2,000 meters in strike length, in lateral extent, and down to depths of just under 600 meters. Fast forward to today, and the resource has grown to nearly 6 million ounces, with a high grade plunge down to 1 kilometer, as seen here on this long section. That was mainly focused in Block 4, but you can also see now that there are ore plunges in Blocks 5 and 6, and importantly here, this ore body is open along strike. So it's about this lateral extent, this broad opportunity, and the ability to extend the resource through exploration. And the geology that I understood here at Reunion, I can then apply to G2 Goldfields next door. So the next site visit was G2. Same methodology here. Again, I had a geological orientation at their exploration offices, which at the time is pretty thirsty work given the humidity. And then I review all the geological models and look at the geophysics. And if you can, just remember this geophysical map on the right-hand side for later on in this presentation. It becomes quite self-evident and important. So the best thing is to look at nature's lie detector, which is drill core. Same approach as Reunion. I visit the drill core, the shed, I viewed the drill core, conducted QA/QC, referenced structural geology with cross sections, long sections, and then you add in the assay results to try and figure out what's going on. And importantly here, the nature never lies. It's usually the companies that do. So you go on these site visits just to define that and see what's going on. Next one, controls on mineralization. So it all boils down to what's going on and where's it going. So this structural corridor here at G2 can be traced for over 20 kilometers. And importantly, G2 controls around 17 kilometers of this strike through their property tenements. At the time, back in 2023, G2 had delineated 1.2 million ounces, not the same size as Reunion, but they're early in their stage of exploration. But importantly, their resource grade was over 9 grams a ton. And that was hosted in 5 really discrete multi-kilometer long shear zones called the Oko Main. Again, there's a plunge to this mineralization, and understanding these structural trends was important. Here on the next slide, the geology doesn't stop at the property boundaries. So when you compare the long section projections of the resource envelopes at Reunion, now G Mining on the left, and G2 Goldfields on the right, we see similar styles of ore plunging. And the challenge here was, on a brief site visit, was really to try and understand what are the structural controls creating this plunge. And this is called the intersection lineation, for those who understand. It's basically where geological structures coalesce and create a plunge. This slide here, I've annotated the drill core, and as my old geology prof used to say, ironically, it's my 30-year university reunion this weekend. So hopefully we'll meet some of the old professors again at Bristol University. But he said, listen, Mark, if your nose isn't scratched, you're not looking hard enough at the rocks. So, you've got to analyze what you see in front of you. Here, analyzing the drill core and recording all the orientation of geological features, you can develop a three-dimensional model, really try and explain where the gold is and where to find it. If you then start recording this data and this grade distribution plots, you can then overlay them on the structural orientated data, which you've collected from the drill core, as you can see that I've annotated here. And what that does is it allows you to put three-dimensional data on a two-dimensional image and work out what the structural plunge orientation and an opportunity is to try and figure out where these mineralizing fluids are going. So in this instance here, it's these intersection of structures that creates these permeability networks for the mineralizing fluids, which importantly host the gold. And it's where these structures, in this case, it's the shear 2 and shear 3, S2, S3, intersect. What it does, it creates an intersection lineation, and it creates a zone of low pressure. And during that scenario, the gold dumps out. So that's where you want to target. And these gold-bearing fluids, after the vein formation, are accessed by this intersection. And importantly here, the G2 geologists recognize this at a very early stage. So I said they've only got 1.9 million ounces back in 2023. They figured out where to target the high grade, and that's over 9 grams a ton. Fast forward to today, and the resource is over 3, going on to 4. So it's the identification of this competent host rock with the prospective shear zones are critical. Hence, this became the focus for the geologists when targeting and siting the drill. So it's all about this big picture thinking. You see here, piecing together the geological information from hand specimen or drill core at small scale leads to a geological model, and geologists like to kind of romanticize in a geological model because it helps focus the exploration efforts in the mind, trying to think in 3 dimensions. Importantly, what it does, it creates a focus and target drilling. And when drilling costs around $250 a meter, the less drilling you do, which doesn't come up with great high grade or gold intersections, the less money you lose, the more efficient you're maximizing your exploration dollar into resource definition. And importantly here, what you find in hand specimen and outcrop, you can apply in a regional setting as the geometry of geology replicates itself. It's all about that big picture thinking, from small scale evidence to big picture regional district opportunities. So on this slide here is quite important. You see a small example of an outcrop on the left-hand side of this slide here. And it's a zoomed in version of what I've highlighted on the right-hand side. You see the orientation of the structural geology here is very, very similar to what I annotated and showed you on that slide 2 slides ago, where you see the drill core with the S2 and S3 structures. So this is a real life example. It's not just been fabricated on some drill core. And then if you look at on a broader scale, so you see here these 3 geologists from G2 standing at an outcrop, you can still see that same sort of intersection of structures and that plunge. And again here, it's that intersection of structures creating that plunge. And it's a familiar theme from company to company, from property to property. So you can see I'm building up a database and really a flip chart of evidence of this thing's going to grow. That's why effectively we invested in the company. So putting that into a regional perspective here, you see the same intersecting features, but now this is on a 10 to 20 kilometer long scale, not on the meter scales or the centimeter scales. So remember that geophysical map I showed you back in 2023 when I visited the operations there with the tasty bank spear in the foreground. Fast forward to 2.5 years, and G2 drilled that intersection of structures back in March 2025. And you can see they made some really interesting discoveries. And this is 5 kilometers northeast of the existing 9 million ounce gold camp endowment of G Mining and G2. And you can see the grades here. We're looking 50 meters at 1.1. We've got 21 meters at 1.6, 8 at 4. Given where the gold price is, this is super economic ore. So the question then is, what do the Amati boots on the ground lead to, apart from air miles and some interesting site visit stories? Well, it's about value creation here. And George initially talked about the merits of investing in G Mining. Well, G Mining saw the potential in Reunion and acquired the company back in May 2024. That changed the company value of G Mining over this time. And this is a real life example of that Lauzon curve, which George explained on the outset. And G Mining acquired the Tocantinzinho asset in Brazil, and Reunion as well. Both of those assets were acquired at the low point in the value of those assets on the Lauzon curve, which usually is at the resource stage or the feasibility, i.e. the pre-development stage. And as that company unlocks the value and does the development, exploration, and de-risks the asset, the value of that in situ resource goes up. And so the de-risking creates value. And if you're confident enough to invest in that de-risked or that risked asset early stage, you participate in that value uplift. And you can see that G Mining has done just that. Here, you see the value that was unlocked by G Mining. So when they acquired the Tocantinzinho asset, by developing that asset, the share price and value creation in G Mining went up 186%. So we talk about price to net asset value. So that's really what the market's prepared to pay through share price valuations of that in situ asset. And it went from 0.35 times to 0.95. And during this period, you can see we invested in Reunion. That was in May 2023. I've highlighted that on the red arrow. But importantly here, because G Mining took on more development risk by acquiring Reunion Mining, the market, for some reason, sold the whole company off because they thought G Mining had taken on too much development risk, even though that by then they'd demonstrated to the market, and George said it's a rare occurrence, that they developed an asset in Brazil on time and on budget. So they demonstrated they can do it. So we added more to G Mining, taking advantage of a discount entry further into Reunion and into G Mining. And this is a classic example, and it's called the Lauzon curve response, where we expect the market to re-rate an asset over time, but they're not prepared to take on that development risk as we are in the fund. The same sort of trajectory of G Mining will follow as Reunion did, and G2 through development, drill bit expansion, resource expansion. Again, they're a piece of the puzzle which is part of an M&A jigsaw. The stock's up 325%. So we participated in that quite nicely. And we believe there's more to come here. This is an example of the third leg of our M&A stall in the Amati Strategic Metals Fund. That 20 kilometer long structural corridor shared between two companies eventually will be consolidated by a major, just because of the potential in this region. So I think it's really this juncture where, I just want to say Amati boots on the ground. What do they do? Well, we go on site because you can't lick rocks and the kick tires from stuck behind the Bloomberg screen. So I think, with that, I hope I've given you an idea of what happens when we go on site. I can't tell you all the stories, but I'll just give you the more academic ones. And Colin, let's open up for questions.
Thank you both. That's fantastic, fascinating, much appreciated. Just in time, we have time for a couple of questions. Obviously, you kind of talked through the benefits of doing site visits and the opportunities you spot that maybe others haven't. Got a question on here about, have you had any site visits where you've encountered practices that actually stop you from investing? Do you want to take that, Mark?
Yeah, I'm not going to give you the locations or the company names for obvious reasons, but there's quite a few times you go on site and you do all your desktop analysis and you come away with an idea, right, this is interesting, let's go on site. And this was a gold company, and they had a resource, and it was just over 1 gram a ton global resource grade. You know, in this gold price north of 3,000, that works. That's economic ore. Probably the margin would be around, I don't know, $750 an ounce produced, if not more. But when I went on site, what I saw through the drill core was there was an over-reliance on these little veinlets in the core. And usually these little veinlets carry the high grade. And when you look at the resource, and it getting a bit technical, but the variography of this resource, it became obvious that it was binary. There was a very large low-grade portion of the resource, but the grade was boosted, which was around 0.6, 0.55. It was boosted by a very small amount of high-grade gold in the veinlets. And I don't like these scenarios where you have a binary gold distribution, because generally what happens is, in this scenario, you're going to have to bulk mine this asset, mostly as an open pit. And during bulk mining scenarios, when you're mining probably 3,000, 4,000, maybe 5,000 tons a day, you get what's called a mine call factor, which is a loss of grade. And it's basically where ore falls off or waste is mixed into the ore. By the time that ore goes from the mine to the mill, and then you produce your ingots of gold, you can back calculate or reconcile what the grade is from all the tons you mined. And generally what happens is you get about a 20% loss. So then I was looking at this asset saying, well, if this resource, which is binary, is relying on these high grade veinlets, reality is a lot of that is going to get lost in the mining and processing of the ore. So then I looked at it and said, well, this is actually a 0.55 gram a ton ore body. And you're going to have to bulk mine it in quite a remote area. And it's going to be reliant on diesel power. It's not renewable energy. The numbers don't start to work out unless you start to increase the scale of the operation. So you mine more to reduce your economics to make a margin. So in this instance, we didn't invest in the company, mainly because on the presentation you saw, look, okay, global grade of 1, yeah, this works. But when you do your DD and you find out from the drill core, as I said, nature's lie detector, we backed away from that investment.
Thanks for that, Mark. I got a question here. We've obviously talked quite a lot about gold exploration. What's your current view on precious metal miners, and what percentage do we have in the fund? Just quickly on that.
We're still holding right now about 67% in the fund. As I mentioned early on, we started to get that money trickling down into the sector, where our view over the next 10 years is probably to bring that down to about 20% in the next few years. But it's really, John, we're looking at opportunities right across the sector. For example, this afternoon I'm seeing a copper company that's coming through London, development play. So each time we'll use that same rigor of looking at it. In February I went out to Arizona. I saw 4 different development projects on the copper side in Arizona, and they each had their own challenges and risk associated to it. So it's really a case of looking right against the spectrum, seeing again it comes back to where we're seeing the value, where we're seeing the most upside risk, and it will change. The maximum we could have in the precious metals about 70. It's done extremely well for us. We've taken some profits on a few companies already, but we're still sitting pretty much overweight the precious metals. Obviously, we all are aware what's going on geopolitically, and that's helping to keep the gold price at a pretty high level. It's not only geopolitically speaking; it's also central banks are worried about the debt that attached to fiat currency. So they they purchasing gold at record levels. So we have a lot of tailwinds for the gold price right now, and that's still not reflected. And in our experience in doing this for multiple decades, there's always a catch-up trade, and so that's really where we sit now, John.
Okay, well, given the time, probably cover just one more thing. You both talked and alluded to kind of interesting trip stories, things that happen. Either of you want to share one of those as a closing remark? Who's going to go for it? Or are they not webinar friendly? Well, should we leave that one for now? Or
I think Mark's on mute. He's got a number of very good stories.
So I mean, there's one. Okay, there's it's a safe one. So I went to Senegal, and sometimes you do get some fund manager or investors come out, but they very much come from the big smoke, and they're not used to getting their boots dirty, if indeed they bring boots. And we were coming back from a mineral sands project in Senegal, and we got flagged over by police traffic cop. Obviously, he was just doing his job, so to speak. But it was getting towards the holidays, so obviously he wanted to buy his family some presents. We got pulled over for an erroneous speeding offence, and the guy started to write a ticket out to us, and then he made out that his pen broke. So he leans his head into the van, and this fund manager next to me, no names mentioned, pulls out his Mont Blanc pen. So who takes a Mont Blanc pen to the bush in West Africa? The police cop looked at this pen, and that's his holiday made for years, and then continued to write out the ticket, gives it to the driver, and then walks off with this guy's Mont Blanc pen. And the face of this fund manager was like, "That's my Mont Blanc pen," and I said, "That's gone, mate. That's you shouldn't have brought it to the bush." So that's a clean story, at least.
It indeed. That's great. We just have one question that's just come in that we can deal with very, very, very quickly. It's in your precious metals exposure weightings, do you hold any platinum exposure? Any view on that?
Yes, John. It's we have taken a view from the start of setting up the fund that we didn't want to give the investors exposure to deep level mining, and especially in South Africa, given the fatalities, given the all the social challenges in country. So apart from Norilsk, which we couldn't visit, or small exploration or development plays in Canada, there aren't many investment opportunities in the platinum group metals. It's a very small sector. It's prone to squeezes from every now and then. We keep an eye on it. Obviously, platinum's had a good run. Part of that is on the mismatch of delay in the rollout of EVs, where the market again speculates, funds take positions in platinum, the price squeezes up. It had a good run. Ultimately, if you look over the next 10 years, the use of platinum palladium has been phased out. So it's a twilight industry that's going to have its moments in the sun. So it's really a case of longer term, you don't want to be in that sector. Short term, there could be opportunities, but again, you're taking on all the risk in South Africa, and being such a small sector, it's prone to manipulation and squeezes. So it's a difficult one for us. I think there could be some money made for speculators in the short term, but in the longer run, even increases in platinum demand, which we're seeing in China on the platinum side, is not going to offset the platinum and palladium used in autocats. So that's the reality of that industry.
Okay, brilliant. Well, thank you, George. Thank you, Mark. Thank you for everyone who's kind of dialed in and listened today. If any of you want to just talk about commodities in general, or, you know, George and Mark, more than happy to take further questions afterwards. If any questions on the fund, please get in contact with one of those on the sales team. And yeah, once again, thanks for joining us. Thank you.